Good morning, hello and welcome to Opening Bell. You're with us on Money Control. It's a Monday morning. I'm Surabhi Upadhyay and the war has entered its third week and the weekend has not brought forward too much of good news. The barrage of missiles and drones, they keep getting fired and the result is that oil continues to inch higher and higher. In fact, that's what I want to start with. So as this week rolls out, let's take a look at the most critical commodity price as of now. So you can see Brent crude when we ended trade on Friday was around $100. And this morning as we're getting started, we're talking levels of about 104. The entire risk-off sentiment has also meant that the dollar keeps moving higher. And again, the dollar index was at around 99 by the time we were trading and closing out the session on Friday. That's the dollar rupee. Obviously, that is a big concern. The dollar index, the international dollar index, is at 100 as well. So, dollar is higher, crude is higher, and Asian markets are cautious. Most of them, for instance, the Nikkei is seeing a little bit of red, a bit of caution in the Hong Kong markets as well. Most of the region is mixed to slightly negative. That's the picture right now. The big question is the bulls on the Lal Street, which were battered and bruised last week. Can they see any sort of respite, any sort of a relief up move? Well, before we get started with the headlines, let's play out the latest statement from US President Donald Trump. Now, he says that Iran has been essentially defeated and that Washington is now in talks with other countries to help secure the Strait of Hormuz. Essentially, the US is now calling others to get the channel reopened, saying, we don't need the oil from Hormuz, you do, so come and get it open. Take a look.
We had some very good results today, as you probably heard, in Iran. Very strong results militarily. Results. We're talking to countries about policing the straits, because they are the ones, we don't get oil, very little, 1%, 2%. And China, as an example, gets about 90% of its oil from the Hormuz Strait. And nice to have other countries police that with us. And we'll help, we'll work with them. China's an interesting case study. They get most of their oil, as by far, a lot, about 90% through the strait. So I said, would you like to come in? And we'll find out. Maybe they will, maybe they won't. There's some other deeper reasons why they should come in my opinion. Militarily, as far as I'm concerned, we've essentially defeated Iran. I guess they can have a little bit of fight back, but not much. Not much. We've taken out their air forces, we've taken out their navy, we've taken out their air defense, and there's no air defense whatsoever. We've taken out their leadership times 2 or 3, might be 3, we'll find out soon. But militarily, it's been amazing. We attacked Kharg Island, and we left just one little area standing at the standing corners where they have the pipes, the oil pipes come in.
The war in West Asia enters its third week. US and Israeli forces continue to pound Iran as Iranian counterattacks continue. Iranian Foreign Minister Abbas dismisses US President Donald Trump's claims that Tehran wants truce talks. Also says Iran is open to countries who want to talk to US about who want to talk to us, that is Iran, about the safe passage of ships via the Strait of Hormuz. Crude oil prices continue to trade above $100 per barrel following U.S. strikes on military assets at Iran's Kharg Island, which was attacked over the weekend. Trump also warns that energy infrastructure could be targeted if Tehran interferes with the Strait of Hormuz. Gold steadies around the $5,000 per troy ounce mark. Oil continues its rally. Stocks on Wall Street and Friday's session lower as investors digest situation in West Asia and surging oil prices. Markets in Asia Pacific open mixed. Investors keep an eye on the price of oil. The GIFT Nifty is suggesting a positive start for Indian markets. The government urges households having both PNG and LPG connections to surrender the latter and also refrain from getting cylinder refills from any public oil company through its distributors amidst disruption in global fuel supplies. Commerce Minister Piyush Goyal tells Network 18 that the government is covering LPG and PNG requirements through diversified sources of imports and there's no need for panic. The Election Commission announces assembly elections scheduled for 5 states, falling in Assam, Kerala, Pondicherry. These will take place on April 9. Tamil Nadu will vote on the 23rd of April, and West Bengal's second phase of polling will happen on the 23rd of April and the 29th. Counting of votes will take place on 4th May. Okay, very quickly going over the most important cues, like we just showed you on the price ticker. There is no de-escalation in the war. Trump is now threatening to go back and strike Kharg Island, which is the most important geopolitical point for Iran, because that's where 90% of the country's crude oil production happens and the exports happen from there. Trump is saying right now we haven't struck oil infrastructure in the island, but we can, and he says we could do it just for fun. I mean, Trump being Trump. Mike Waltz, the US ambassador to the United Nations, said that President Trump is not going to take any options off the table, suggesting that a strike on oil infrastructure is still very much an option. In the meantime, we also heard from the US Secretary of Defense, Pete Hegseth, who said that Iran's new supreme leader is wounded and disfigured. And again, they kept on claiming that a lot of targets have been hit and the war is essentially, it's been won. Now, the market is not really taking any heart from any of this chatter. The fact that now the US is calling its allies to come in and secure Hormuz, it's very clear that the US wants to step back, and it's leaving the job now to other strong global powers, including China, including the UK, and options are not very clear just as yet. So in the meantime, oil is still climbing. Equity markets are suggesting that they want to pull back a little bit at least, because we were perhaps deeply oversold with the 5-6% cut last week. And therefore, the hope is that maybe the Indian market will also see a little bit of a positive start. On Wall Street, we again had a negative Friday. Indices were down between 0.2% to 1%. The Nasdaq fell the most. Q4 GDP in the US has been, by the way, revised sharply lower. Just keep some of these points in mind, some of the economic data points from the US. So initial estimates put the GDP at 1.4%. Now it's been revised down to just 0.7%. And inflation in the US is still sticky. Core PCE, which is what the Fed looks at very carefully before deciding policy, is up 3.1%. It's above the Fed's comfort zone, and the Federal Reserve is meeting this week. So we'll look at the expectations. Right now, the market is not expecting a rate cut or any other policy change from the Federal Reserve. Now, the question on India, will the bulls manage to fight back at all? Down 5% on the Nifty last week, down 7% on the Bank Nifty. Every single index was down on Friday. It was the kind of capitulation we've not seen in years, backed by a lot of FPI selling. On Friday, FPI sold off cash stocks worth almost 10,700 crores. Domestic institutions were buyers, but this amount of FPI selling is putting further pressure on the rupee. So we'll watch out for the rupee opening at 9 a.m. The closing level was 92.46 on Friday. So very, very tentative. Let's straight away get to our experts to figure out how you should look at trade this Monday morning. We have Vishnukant Upadhyay joining in from Master Capital Services, and we have Ashish Chaturmota, Managing Director and Fund Manager at JM Financial. Ashish, good morning. Thank you so much for being with us. So it's a bit of a dichotomy this morning, right? Cues are not positive. The war is still on. I mean, the US claims that they won it, but the Strait of Hormuz is still shut. Oil is still higher. Would you expect a bounce back, some sort of a relief rally in equities today or later this week?
Hi, good morning, Surabhi. So I think we are in a very, very uncertain time, and during these periods, we say that avoid a falling, catching a falling knife, and this applies in today's scenario, because it's not a fall just in equity markets, but we also need to see the the corresponding or the relevant metrics to it. So if you look at rupee is hitting a fresh all-time lows. Crude has been continuously hitting 100 and 100 above in terms of dollar, and we have already seen almost 70-80% kind of rally from the lows. And we have seen in the past also, whenever this war or war-like situation has emerged, we have seen crude seeing extreme volatility. So we can't predict whether crude will sustain at 100 or it might go to 120 or might even see $150. And indeed, in these kind of scenarios, it becomes very, very difficult for anyone to predict what could be the earning metrics for a lot of the companies, because we are dependent on crude. Almost 85 to 90% of our requirement comes from crude. There's going to be a supply shock from a commodity side, whether it's crude related derivatives, naphtha, or even there's going to be a supply shock on other commodities as well. So all this is going to put pressure on the earnings of quarter 4, and the estimates are not going to help in today's environment. So keeping all this in mind, I think it's a very tricky situation. When we look into the broader technicals, we have already breached the 200-day moving average and sustaining much below the 200-day moving average. So till the time we don't see a consolidation happening for 1 week's time frame, I think it's more of a sell on rise kind of market. So clearly at this juncture, traders should avoid it. As far as investors is concerned, ideally the strategy should be to buy in a staggered manner and give time frame of next 2 to 3 months to accumulate high quality stocks where one intends to hold for a longer period of time.
Okay, all right, got it. So for traders, this is still short the bounce kind of a market, that you sell the rise. And for investors, Ashish is saying go in a staggered manner. Let's talk about the trading advice first, Ashish. So, I mean, the whole market was down so brutally, right, on Friday. Bank stocks were falling, auto stocks were falling, nothing was spared. Even defense, even defense stocks for that matter, finally they succumbed to pressure. So now for traders, apart from the Nifty, what else looks like a good shorting idea?
So see, I'll tell you, see what we don't like, we don't want to recommend what is going to be on the short side, but what I would recommend is as an investor, where the opportunity lies and where in the staggered manner one can look to accumulate. And obviously from a negative perspective, obviously anything which is dependent on crude is going to see a lot of pressure, and whether it's auto ancillaries, or whether it's airline stocks, or something like oil marketing companies, or companies like Asian Paints, Berger, these are clearly avoid at this juncture because there is huge dependence on crude and crude related derivatives. But as far as the long is concerned, where the staggered manner approach can be applied is the banking space, Surabhi, because we need to understand, if you look at private banks today, the loan growth momentum has started picking up around 15 to 16%. If you look at ROAs of most of these private banks, they are it's around 1.2, 1.5%, and the ROE is in the range of 18 to 20%. If you look at the credit cost, it is much below 1% level, and that is giving a lot of comfort in terms of asset quality of a lot of these high quality large cap banks. And since the valuation is just at 1.92 time price to book, I think any dip on these high quality names like Axis Bank or ICICI Bank is an opportunity to accumulate. Maybe there could be a pain for another 1 month, 2 months for even for these stocks, but I think if one look at from a 6 to 12 month perspective, from a portfolio perspective, I think both these banks in the private sector looks very promising bet. And even if you look at PSU banks in general, they are trading at around 1 time price to book with the same amount of positive metrics on loan growth, on the net NP numbers, as well as the credit cost in line with their private peers. If you look at the quality of retail, the amount of retail loans which has started picking up on the PSU banking side, it has seen a good share of retail loans, and that's where the NIMs are also going to expand for a lot of these PSU banks. So all put together, PSU Bank B's ETF could be a good proxy to ride this entire PSU banking rally, which might happen at some point of time. From a technical perspective, yes, maybe 5 to 7% downside could be anticipated, and that's where I think the accumulation strategy will start playing out.
Okay, that's an interesting approach. Thank you for that. Ashish is saying that you could maybe look at PSU banks as a basket, play that through an ETF, and you can also have specific larger private sector names. He likes ICICI Bank among others. So noted all that. Ashish, coming right back to you for some other ideas as well. I mean, portfolio ideas, right? This is a market where you can start building long-term portfolio positions. So we'll come back and talk more about that. Vishnukant Upadhyay is also with us to talk technicals, to give us some sense of the immediate trades, the here and now trades. Vishnu, hi, morning. For near-term traders, Ashish was just saying, though he's talking more about the investors, but I mean, he was saying for immediate short-term traders, probably this is still a sell the bounce kind of a market. Would you concur? And then if some specific levels, Nifty, Bank Nifty, for intraday trade or next 1-2 day positional trade, what are those shorts? And will you look at any longs if the market is indeed oversold?
Well, good morning, Surabhi, and good morning, Ashish ji. 100% true that for a short-term market is completely looking bearish. And today in morning, I was seeing that GIFT Nifty was trading with a gain of around 120, 130, and now that gain has been fizzled out, and currently it is trading with muted tone. So this bearish texture will remain intact at least for short term. So for intraday, for a 2 or 3 days holding, I will keep shorting the market on every rally. For today's point of the view, I would say as long as prices are trading below its 21 EMA on hourly chart, which aligns somewhere around 23,500, every rally could be used as an opportunity to build a fresh sell positions. For intraday in Nifty, I will bait prices to come towards 23,300 to build a fresh sell position in Nifty, while in a Bank Nifty, I will bait prices to come somewhere around 54,100 to build a fresh sell position in a Bank Nifty. So that's my view in Nifty and Bank Nifty. Now let's come on a particular stock. So for a short-term buy, although most of the stocks are in the oversold trajectory, such kind of bloodbath market, but few stocks are looking quite good for a short term. So first stock is ABB, and we can see on a weekly chart, and we will find that the stock has given a very decisive breakout from the stiff horizontal resistance, and now the stock is all set to extend this winning streak towards 7,600, while on the lower side I believe the stop loss should be placed below 5,900. Second stocks will be from the defense sectors, and that is a data pattern. So basically we have seen turmoil in prices on Friday's trading session, but overall texture, if we talk, that's a very sound. Prices are completely forming higher highs, higher lows kind of patterns, and currently it is trading somewhere around 3,200. I believe for a short term, one can buy the stocks with keeping stop loss below 3,050. On the higher side, I am expecting prices are looking to pave the way towards 3,800.
Okay, all right, got it. So data patterns is on Vishnu's radar. By the way, data patterns won some orders as well. Speaking of which, let me quickly run through some of today's interesting stocks and news, and then we'll come back, keep talking about more investment ideas and more trading ideas with both our experts. So here's today's stock list in terms of news flow. Interglobe Aviation has introduced a fuel surcharge over the weekend. Now, Indigo says that this is because of soaring oil prices. The cost of jet fuel has just gone up dramatically. And this is on all kinds of routes. So if you're flying domestic or within the Indian subcontinent, then the fuel surcharge is 425 rupees. For West Asia, it's 900 rupees. Southeast Asia and China, 1800. And Europe is the costliest. Surcharge there is 2,300. And of course, the company is saying it will keep checking the situation. It's an evolving situation. We'll come back with more. But as of now, these are the additional charges that they have put in place. Lots of order wins. Ramki Infra has signed a 3,000 crore rupee concession agreement with MIDC. This is for a project that involves developing a high-tech pharma park in Maharashtra. It's going to be built around the Dighi Port industrial area. Dilip Bilkon in focus. It's emerged as the lowest bidder for a 160 crore rupee road project in Odisha. So keep that on your radar as well. CMEC has bagged orders from ONGC. The value of these orders is about 400 crores, 411 crores to be precise. So that's on our radar. Speaking of order wins, Bejel Projects has won a large one, 700 crore rupee order. This is from the MSETCL, which is the Maharashtra State Electricity Transmission Company. This is to set up a power substation at Pune. And Data Patterns, like I was saying, Data Patterns has also announced order wins. They've won an order worth about 279 crore rupees from the IMD for a supply of 34 units of Doppler weather radars. So good news coming in for Data Patterns over there. Hindalco has clarified there were certain reports of disruption at their smelters. So the company clarified over the weekend saying that the aluminum extrusion operations have not been halted. There was a minor disruption risk which affects less than 0.1% of their operations. So they're saying essentially nothing to worry about. Those are some of the stocks in focus. Let's go back to our experts to talk about some portfolio ideas now. And Ashish, I want to come back to you. So you spoke about financials. You gave us a couple of ideas. What else are you looking at in this market? And defense is pretty interesting because when the war started, there was a little bit of a, sentiment uptick on defense stocks. But now I think the sentiment is so subdued that even defense names are falling. Are you adding anything to the basket here? And within this, let me ask you specifically about L&T. L&T is defense, infrastructure, it's everything. But it's been hit very hard for reasons we all know in this West Asia conflict.
Yeah, so Surabhi, yes, so we are quite constructive about the entire defense as a space because defense, first of all, is not a discretionary spending, and the way geopolitical changes are happening, this is going to be a very strong theme. Earlier challenges with respect to government is going to be the only buyer and all those has kind of always restricted the PE multiple re-rating, but in the last 2 years we have seen a serious re-rating coming into the entire defense as a space. We like within defense space stocks like Bharat Electronics Limited and Data Pattern because the entire electronic warfare is going to see a very strong surge, and both these companies have started doing extremely well on the operational parameters, whether it's the top line growth or margin expansion or indigenization or everything. If you look into these companies, we have seen it checking all the positive checklists, and that's where I think companies like Bharat Electronics Limited and Data Pattern looks very promising bet from a medium to long term perspective. As far as L&T is concerned, obviously we know that 38% of its exposure is into Middle East, and that's where a lot of challenges are happening. And if you look at the incremental order book which L&T is having, out of that a meaningful order book is from the Middle East, and that's where I think markets are punishing stocks like L&T. But we believe that any dip towards 3,200 to 3,000 would be a very attractive opportunity to get on the long side of L&T. So yes, in the shorter term there are some headwinds, but from the long term perspective, looking into the order book positioning, looking into the execution capability and the margin profile, L&T looks very promising bet, but on dips. So that's where our view is. Now, I mean, one more thought I would like to share is if you need to understand the regime, current regime, and if you look at in the current regime, inflation is going to cross the targeted inflation zone because of the commodity supply shock we are witnessing. Second, interest rates are not going to come down. In fact, we might see a situation where interest rates might start going up, and the growth, the GDP growth of most of the countries are going to remain moderate. So in these kind of scenario, we have seen energy, financials, commodities as and value as a theme to do well, and that's where our entire thesis of going long into CPSE ETF remains as our topic, because this ETF has got good exposure into energy through NTPC, Power Grid, through oil, through ONGC and Oil India. And since we like defense, we have got good exposure of HAL and BL in this CPSC ETF. So we would like to play this entire basket through CPSC ETF. And if you look at the price performance of CPSC ETF in the last 1-2 months time frame, when the markets were looking extremely weak, this ETF has given positive returns, so clearly indicating on a relative basis also this CPSC index is showing very strong resilience.
Okay, all right. So plenty of ideas there. Ashish, stay on. Before we let you go, I just want to quickly recap and get your best, let's say, 3 or 4 buy ideas. Because it's that kind of a market, and then we'll put that out separately for our viewers as well, so they can keep referring back to it on social media. But before we talk about those compounding ideas, Vishnu, a specific take on metal stocks and auto stocks, because on Friday they were falling as if the world is ending. I mean, the auto index last week ended down almost 10%, and metal stocks have been getting a severe pounding as well. Any trades here? Auto, metal? Otherwise, you also please just recap your top trading ideas specifically for today.
In fact, there has been very tremendous selling in metal and auto space. And technically, if I look at the chart, auto is not looking good, at least for a short term or for an intraday purpose. Yes, the index has been oversold, so we cannot rule out the possibilities of some corrective bounce, especially in the TVS Motors. So yes, if let me look at the chart of TVS Motor. stock is currently trading below its 200-day exponential moving average, and also below its stiff horizontal support that aligns around 3380. So I believe some corrective bounce can be seen in this stock, but for long-term perspective, we can say we can buy, but for a short term, we cannot say we can buy. For intraday, we can expect some bounce back, and that bounce back could be fizzled out somewhere around 3390. So for that bounce back, you can buy TVS Motors, but yes, that's not a promising buying in the auto space. And for a metal space, I would say GSW still is also in a oversold trajectory. But yes, I'm expecting some bounce in today's trading session. So one can bet on GSW steel, and I'm expecting the stock could approach towards 1145, 1165 kind of levels.
Okay, all right. And Vishnu, by the way, the pre-open rates have just started coming in, and the Nifty is very quiet. And our viewers are asking, Narendra is asking us, good morning, Narendra. He's saying Nifty levels again, please. So since we're looking at the pre-open right now, Nifty is undecided, flip-flopping 15-20 points here and there. Vishnu, once again, what is the Nifty trade for today? Nifty, Bank Nifty, whichever is a better index. And will the trade be on the short side or the long side?
Well, so trade will be the selling side. For a better, index, I would say Bank Nifty is looking, slightly more weaker than a Nifty, because we are, seeing pain from the private banks as well as from the PSU banks. So having said that, any rise in the market close to 54,100 will attract a fresh selling. Maintain stop loss below 54,300, while on the lower side, I'm expecting 53,500, 53,400 will be on card.
Okay. All right, Vishnu, thank you very much for giving us the trading calls of the day. You have a good session, and we'll connect again soon. By the way, we've got more viewers joining in on our YouTube feed, and James is saying, can you please suggest some equity stocks? James, you joined us late. For your benefit, I'll recall or recap, Ashish has been giving us plenty of ideas. He just told us that you should be looking at the PSU Bank ETF, maybe an ETF product, just buy the basket. He's given us some ideas on L&T. He likes a couple of defense stocks as well. So in fact, let me do this for viewers who are joining in now. Ashish, let's recap some of your top ideas. So for someone looking at creating a fresh portfolio or adding fresh stocks to the portfolio for the medium term, what would your 3 or 4 top bets be?
So Surabhi, I would just like to summarize what we have already mentioned, and I think private banks, Axis Bank and ICICI Bank would be our top pick. In the PSU banks, rather than taking exposure into 1 or 2 names, I would suggest that PSU Bank BIS ETF is a safer bet to ride this entire rally. What we anticipate in the entire PSU banking space because of the valuation, because of the credit growth momentum. Apart from that, we are very positive on the energy, defense, and power as a sector. And to play that, one could even look into stocks like NTPC Power Grid. But if one has to take a very some of the parts kind of approach and want to play all thing at through one index, then I think that would be CPSC ETF, which has got exposure into oil, into NTPC, into Power Grid, into defense names like HAL and BEL. And from an individual stock perspective, I think data pattern is one stock which looks very promising in the defense basket because of the play on the electronic and the way electronic warfare is going around. So I think data pattern would be our top pick within the defense space.
Okay, so those are lots of trading ideas. Ashish, as we let you go, the market is still so slippery, and I think that's where the fear is now getting real. I think in the earlier part of the war, when the market had started falling, people were still deploying a lot of capital. Now we're 10% off the peak. Again today, right now the Nifty is suggesting 40, 50 points lower. If anyone's buying now, what should their minimum time horizon be, including the picks that you mentioned, Ashish? What's the final advice that you would want to leave our viewers with today?
So Surabhi, I want to be very clear that this is going to be a challenging time looking into the global uncertainty. It is not just about Iran and, Iran-Israel war. It is about this entire Middle East under stress, and this is going to get reflected into, crude, into crude-related derivatives, into other commodities also. So there is going to be a commodity supply shock, which we are going to witness. This is going to put pressure on earnings on margins of a lot of Indian companies, and that's also going to derate our multiples to some extent. We are already seeing intensified selling from FI, and at the same time, rupee has fallen to an all-time low level. So in these kind of trajectory, we believe that yes, there's going to be a pain, and this pain can last for another 2 to 3 months time frame. So ideally, someone who is creating a portfolio, one should have this time frame in mindset that 2 to 3 months should be the period of accumulation of high quality companies across sectors where we are structurally positive, and should give at least 6 to 9 months for the portfolio to start yielding any kind of positive return. So that's how I would like to see this portfolio. So 2 to 3 months is a period where a staggered manner approach has to be adopted, and accumulation strategy should be done.
Okay, all right. That's solid advice. And I think our viewers will keep some of those caveats in place. The time horizon is really important. Don't expect a quick flip on your investments right now. Ashish, great having you on the show this morning. Thanks so much. Have a fantastic week and a good day. And we will connect again soon. Thank you. All right. Well, with that, let's do a quick check on the market. The pre-open session, like I'm saying, mostly it's been red so far. We're not getting any sort of a bounce, 20, 30, 40 points lower on the Nifty. That's how it's been. Just lackluster, it's like a slow grind down. And so you're falling under your own weight. That's what happens when markets pick up momentum, either on the way up or on the way down. And off late, it's been on the way down. Shriram Finance, BEL, Aisha Motors. Let's just fire up all the Nifty losers for you to give you a quick synopsis of where the weakness is. Wipro, Tech Mahindra, Bajaj Finance. I'm seeing financials largely weak. Technology is weak. Infosys, for that matter, auto as well. So look at Eternal, look at Tata Motors. It doesn't matter actually, it's across the board. Some of the metal names like Hindalco still weak. Do we have any gainers on the upside? I can see Ultratech Cement up 0.5%. There's some buying in consumer names like Lever and Tata Consumer. Actually, Tata Consumer is not even 1 rupee up, so it doesn't count. Lever is up about 9 rupees right now. L&T is seeing a little bit of a relief buying. I think every single fundamental analyst who's come on our shows over the last 1 week has said L&T is a buy. I mean, don't go by my word, please go back and check all our recordings. I'm saying the general sense from what I recall is most of them have had buys on L&T, seeing it as a good solid fundamental investment idea, but the market right now is dealing with a lot of nervousness and L&T has seen serious price disruption. Okay, so that's equity. Let's go back to the price on oil. And let's do a check on the currency as well, because the currency continues to battle the ongoing macro issues. Though I think the opening has been slightly positive because Friday was almost a free fall on the rupee. Let's look at what global oil prices are doing, what the dollar index is doing, and what the dollar rupee is doing. The dollar rupee, like I'm saying, started the day on a slight positive note, but not too much. I mean, 92.42, 92.43, I think those are the levels that we've got. 92.45, yeah, so I mean, so it's not really standing out too much, at least at this point in time. Let's do one thing. We're going to bring you an expert who will tell us more about how the currency market is dealing with this crisis in the next 1 or 2 minutes. As we get to our next expert, let's bring you some glimpses from Moneycontrol's Global Wealth Summit that happened over the weekend, a marquee gathering of India's investing world. And we had the SEBI chairman himself grace the occasion. So Mr. Tuhin Kant Pandey was there. He spoke about a whole range of issues about the regulatory development of the market and how keeping the market steady and keeping the frameworks working is very important. Managing that volatility and ensuring that systems don't break in the face of volatility is, of course, critical from a regulatory standpoint. He said that India's capital markets are expanding rapidly. According to Mr. Pandey, chairman of the Securities and Exchange Board of India, he said that market capitalization has grown at around 15% CAGR since 2015. He said the corporate bond market is now expanding at about 12% CAGR. Listen into his views.
Efficient capital markets play a stabilizing role in an uncertain world. They enable transparent price discovery. They help absorb shocks without destabilizing the broader financial system. And perhaps most importantly, they sustain investor confidence. India's experience over the past decade offers a compelling illustration of this evolution. India's capital markets have expanded significantly over the last decade. Since FY15, our market capitalization has grown at a CAGR of about 15%. The corporate bond market has expanded steadily at a CAGR of around 12%. The primary market has remained an important channel for capital formation, facilitating around 9.7 trillion rupees of capital raising annually. The number of unique investors in securities market has grown at roughly 21% CAGR, indicating a broadening investor base and a rising household participation. Mutual fund AUM have expanded at over 20% CAGR. The AIF ecosystem has witnessed rapid expansion, with investments growing at more than 50% CAGR, channeling capital into startups, innovation, and emerging sectors, and so on. These numbers tell an important story. India's capital markets are no longer merely expanding. They are deepening, diversifying, and becoming increasingly resilient.
Global Wealth Summit, and we'll keep getting you more snippets of GWS. A lot of experts from all parts of the market, equity, private equity, public equity. Of course, we had conversations on crypto, on real estate, on gold, silver, everything you can imagine, and we'll keep getting you more highlights through the course of the day. But for the timing, as promised, let's put the spotlight on the currency and go back and see what's happening with the rupee, which has continued to battle more adversity on the macro front, with oil at $100 a barrel. Anindya Banerjee, Head of Commodity and Currency Research at Kotak Securities, is with us. Anindya, good morning. Great to connect with you on Money Control finally. I've been looking forward to this one. Morning to you.
A very good morning to you. Thank you for having me.
Anindya, so, where really are we in this whole situation? Because the price of oil is still going up. We don't know when Hormuz opens up. First of all, do you see any conviction? Now, President Trump is calling on other countries to get the strait open. In some of the, I think, posts, he said the war effectively is over from the US's perspective. But I don't think the markets are entirely buying it.
Right, because currently the insurance is not happening in a major way, and without the insurance, so in a way you can say effectively the straits is not closed. It's the insurance which is not available. Without that, we'll not see the normalization of the tanker flows. Secondly, sporadic attacks keep happening, so that creates a fear, because when you move a large amount of hydrocarbon, it is like a moving bomb. If some amount of strikes happen, it can create a major issue, not just for the tanker and the crew, but also can create an oil spill, and that can impact the whole desalination plants across Gulf. So there are a lot of things which are involved. So that's the reason why these frettiers, they are not taking the risk, and that's the reason why we have not seen improvement in the overall flows of not just oil. Gas is almost shut, and also fertilizers and chemicals.
Yeah. So, at times like these, I don't know whether it's right to be asking you about levels to call, but it's been one way. It's been absolutely one way. What is the rupee market pricing in now? Oil at 100 for how many months? Obviously there's the added FPI selling as well. So what are the factors at play here, and what would you expect if the Strait of Hormuz does not open over the next few days and weeks?
So actually, we don't have a script of this since 1970. Maybe we can compare it with COVID. So every passing week now will make the situation worse, because Hormuz had a total capacity flow, if I look at oil, of 20 million barrels per day. We could bypass, let's say, at best 6 to 7 through the east-west pipeline of Saudi or the Fujairah. Even the Fujairah has come under attack. So you're talking about 8 to 10 million barrels at a very conservative estimate, which is offline. And the entire spare capacity of the world almost sits in West Asia. So the whole question is how long this continues. And as it spills over from this week to next, the impact will get worse as we saw in COVID. So the prices, if it continues beyond March, which is the unthinkable at this point in time, then oil prices could jump much higher, and that has a knock-on effect on everything. And it's just not oil. It's just, see, this is not a typical oil price spike which we have seen in so many times in the past. This is the non-availability of oil, especially as I said, gas, your fertilizers, chemicals. So just the prices have to reach that level where it starts to destroy demand.
Anindya, just give us a couple of minutes. The market has just opened, so let me take stock of it and then we'll come back and continue our chat. Look at how this opening was. You know, while Anindya was speaking, I was watching the screen carefully. The Nifty opened, and at one point it was up about 75, 80 points. But the sellers are coming in so quickly. Every bounce is getting sold into, and now the Nifty is barely up 15 to 20 points. So that's the volatility that we have. You open gap up, market is oversold, you open gap up, but that bounce gets sold into immediately. And one can understand why. I mean, there's still a lot of nervousness and no clarity on an actual end of this war, an actual opening of the Strait of Hormuz. Okay, let's go into stocks then and see what's going on. The mid-cap index has already turned negative. The Sensex has already turned negative. The Nifty is practically negative. I mean, 0.2, 0.1. Yeah, we flashed a bit of negative. So market opens positive and then the color changes into red, given just how fragile sentiment is. The Bank Nifty also, all indices red. The screen when we opened, when Anindya was speaking, was green. The screen in a matter of minutes, in less than I think 60 seconds, has turned red. That's the kind of nervousness that we are looking at. Okay, so let's see where the pressure is. It's across the board, but financials and IT largely I can see on the screen right now. Shriram Finance about 2% lower. Infosys is down by 1%. Tech Mahindra is lower. Wipro, HCL, Tech, TCS. So technology is not a support, at least at the start. Some other names like ONGC and BEL are on their way down as well. There is some selling on Mahindra and Mahindra. It's down about 0.5% I can see. Maruti is down about 1% as well. Auto stocks have been largely weak. Though Maruti did clarify that right now the supplies are absolutely fine. In fact, there's no supply chain disruption at all for any of their inputs. The stock's still under some pressure. Bajaj Auto is flashing a little bit of red as well. So these are the stocks on the lower side. Reliance, by the way, is down about 0.5%. So that's a lot of weight on the index on the red side of the screen. Okay, let's see what's working. On the upside, JSW Steel is up. It's looking at coal mining operations, I think in Mozambique. That stock's up about 1.5%. There's some buying on Grasim, on Ultratech Cement. Tata Steel is also higher. A little bit of buying in names like SBI Life and Kotak Mahindra Bank from the financials universe. HUL, NTPC flashing a little bit of red. SBI and Axis Bank. The banks are fighting hard. There's a big tug of war between the bulls and bears on the Bank Nifty at this point in time, which is why that index is flat. Speaking of banks, let's pull up IDBI Bank. Can we get IDBI Bank on the screen? Because CNBC reported on Friday that there are the bids that are being received for IDBI Bank for the stake sale that the government is planning. They're below the reserve price, below the threshold. So it's unlikely that this goes through in the present form. That made IDBI Bank one of the big losers this morning, 12-13% lower as you can see. Apart from IDBI Bank, what else should I call out? Let's pull up the oil marketing companies. Oil, when we ended trade on Friday, was 100. This morning it's 104. So it's straight away a down trade. IOC, BPCL, HPCL, all of those stocks are slightly lower. What else? Some of the names like TTK Prestige, which have rallied so much because of the induction cooktops they're selling. There's profit taking coming there as well. General sense of caution pretty much all around. Let's see what else stands out. A lot of the QSR companies like Westlife Food, the franchisee owners of McDonald's, Sapphire, Devyani International, they're still red on a lot of these stocks. Now I'm checking some of the names where companies got order wins. Is there any excitement there? Begel Projects is one. We should get this stock up on your screen. It was one of our stocks on the radar in our stocks and news list. Begel Project has received a large order, 700 odd crores. So that's working well for that stock. CMEC has won an order, so that's also positive. GMR Airports is going to be looking at expansion at the Delhi airport, I think the cargo terminal. So there's some green on that stock. But apart from these newsmakers, largely it's a subdued market at this point in time. That's what we have. Let's keep flashing more mid-cap gainers and losers for you on the screen. The gainers include some names like an SJVN. I mentioned some of the metal stocks. So Nalco is one of them as well. This Vodafone idea. We'll get the mid-cap gainers and losers for you on the screen right now. But going back to complete our conversation with with Anindya Banerjee, and in a bit we'll have Sushant Bansali of Ambit also joining in. Anindya, so now what next? Like you're saying, there's no script. We're not following a preset format here. But would you expect the RBI to defend levels, to intervene? Typically, the RBI stays out when there is excessive volatility. What would you expect from the central bank now, given the situation?
See, at a time when your FPI flows are negative 6.5 billion in March, and it's just half a month. So the RBI has to be a seller of dollars. Yes, one can always argue that end of the financial year, we will see exporter selling into the market. That tends to happen. So we have a positive seasonality for the rupee. But having said that, RBI has to step in because the exporters might hold out a little bit, expecting that they could get a higher USD-INR level into the last week of the month. So, but at the same time, RBI just cannot come and intervene heavily in the spot market because that will tighten your rupee liquidity. So I think RBI will do a calibrated approach, NDF, forwards and spot, and whatever intervention they do in spot and that leads to a tightening of liquidity, they will try to infuse it through the bond market because that will also help the long-term bond yields. So I think a combination of that will happen, but the RBI has to be a main supplier now.
So I'm going back to the price of oil, which is still hovering around 104. Now, Anindya, this is an assumption that I'm kind of throwing out there. If we assume that oil doesn't cross 105, because now, the great allies of the US are supposed to come in with their own warships and they're supposed to open up the strait, and maybe some sort of dialogue also starts. And by the way, let's not forget that Iran is still offering safe passage to countries like India, who are willing to talk and have a diplomatic channel of communication open. So Iran has constantly said that we're only attacking our enemies, and other countries can talk to us and we'll allow, vessels to pass through. So working with the hope and expectation that some of this means that at least partially the channel opens and oil doesn't cross 105, what's the worst case scenario for the rupee? Has it played out at current levels?
Yeah, so I'll give you a picture of the numbers. See, as I said, 20 million barrels per day was flowing before the conflict started through Hormuz. Now, max you can take out in a very optimistic case 7 million barrels through the East-West pipeline and the Fujairah. Now that leaves 13 million barrels to pass through. Iran exports around 1 to 1.5 million barrels, primarily to China, maybe some flowing to India. So basically, in a more conservative case, even with these safe passages, we could be left with 7 to 8 million barrels short. Now that that creates the overall shortage in the market, and the gas is totally offline. And as I said, fertilizer, the agri season is on. So it's difficult to cap the oil price at 105 if the current situation continues. Because as I said, as you progress with time, the situation becomes worse because the buffer capacity of countries are getting eroded with every passing day. Because the world consumes 100 to 103 million barrels per day of oil, right? So I think if this continues a week, we could see the Brent towards 120 once again. And in that case, the rupee will try to inch above the 93 mark, assuming heavy intervention from the RBI, which I think will be there. But getting it below 90, where we can say the de-escalation has started, I think, as you said, the back channel talks have to start. Just using force may not be enough.
Okay, all right. So I think we have to watch this very, very carefully for the next couple of days. And Anindya, final question on this. I mean, obviously our import bill is climbing substantially. And that is another reason. I mean, it's just adding to all the factors that are leading to excessive weakness, right? So what's the range that you would look at, say, over the next week, 10 days on oil and on the rupee?
On the oil, as I said, on Brent, 90 is the floor now, as long as we are not seeing meaningful de-escalation. And on the upside, 120. Anything above 120 would require the disruption to continue beyond March. which is at this point a low probability, but if it happens, yes.
Okay. Anindya, thank you very much. This is a very helpful context. It gives us some understanding of exactly how the currency market is dealing with this absolutely unprecedented situation and global crisis. Thanks very much. You have a great Monday. And we look forward to more of these conversations so that Money Control's viewers will also be more informed about the ongoings of the currency market. Thank you.
Thank you.
All right. Well, that's the currency talk. Once again, let's look at the equity screen. And the equity screen is looking so fragile. You know what? The mid-cap index has already started falling. The mid-cap index is now down 0.7%. It's a 400-point fall on the mid-cap index. That's the Nifty. Nifty gave up an 80-point gap up to now trade about 40 points lower. So from the high to the low, it's already a 100-point plus swing. And that's the mid-cap index. Well, that is the market that we are in the midst of. Let's take the conversation forward. Sushant Bhansali, CEO of Ambit Asset Management, is with us. Sushant, good morning. Thank you so much for joining in. I don't know about good. We haven't had a real good morning in a while, right? Given the absolutely fragile sentiment out on the on the screen and on the streets. You tell me, what are the conversations saying off late? I mean, logically we all say this is a great time to come in and invest the money. But what are actual investors telling you? Are they still waiting and watching?
Yeah, I think most of them. Yeah, good morning. I think before we get into that conversation, thank God we don't need to worry about any missiles going up in our skies or things like that. So it's not that bad. Things are happening globally, but just about 11 months back, we were worried about the same things as well in India. So thankfully, we are not in that situation. Geopolitically, India at least is too immune at this point of time. And what is happening globally is taking a toll on economy globally as well as markets. And India is not immune to that. From our perspective, I think while it's a great time to buy, as you rightly said, but this time is not getting I would say over in a rush. I think it will take probably few more days, few more weeks for all this to settle. And that's why we've been telling clients start investing, but don't be in a rush to invest everything now. And I think that's something which I think investors are liking as well. I think everybody is worried in some sense as to because the longer the duration of this war is, I think bigger the impact will be. Because so far it's only on I think the immediate use of and I think the biggest thing which we are worried about is the usage of gas, industrial gas. Than anything else. I think oil will find its way and is available globally at many other locations as well from an India perspective. But gas is a big worry. And so far the effect has been more on industries which have been using it now. But if it extends for a period of time, then the whole supply chain is what people need to worry about.
No, absolutely, absolutely. But you're saying that this is still a time to wait and watch. I think that's the question, Sushant, that a lot of people are grappling with, that if I have 100 rupees, how to stagger and how to deploy. I think a lot of people are still holding on, not knowing if we're close to the bottom or not.
Yeah, one will never know when the bottom comes and goes. So our advice to clients has been that start with a 15-20% allocation and on a weekly basis add another 10 odd percent for the next 8 weeks or so. And if the situation improves, then probably cut the rest of the weeks by half. And if it doesn't improve, then probably extend it by another few weeks every week and cut down the positions of investing to play it safe, so that over a 2 to 4 month period is when you deploy and not doing everything right now.
Okay. By the way, a lot of viewers are watching us on YouTube as well. So let me just say hi to people out there. Hello to everyone who's joining us now, who's on YouTube. And a couple of them are actually asking for stock-specific questions. Sai, you want to know more about BEL And I think someone's asking about Vedanta. Paddy's asking about Vedanta. Vedanta, these are all questions we'll take between 8:30 and 9 a.m. with a technical expert. So maybe, you can come back and ask them tomorrow. Shiv Kumar is saying that give some geopolitical immune stocks with reasonable valuation for long term. Now, I don't know if Sushant can give us stocks or not, but let me ask this question. I think it's summing up the sentiment of most people in the market, Sushant, that you want stocks which are trade proof, which are geopolitics proof, which are macro proof, because this war has raised a lot of macro questions as well, right? There's so much collateral damage across the market. So where is the safe zone? Where is the safe haven in terms of sectors or themes, if not stocks?
Yeah, so our approach has been more long-term investing, and from that perspective, there will be short-term shocks. Most of the stocks, I think, in the Indian context, are geopolitical immune. In a sense, India thrives mostly on domestic consumerism, and that will continue to be, I think, a safe haven for long duration of time. Of course, nothing can be sure or immune in the short term, be it a few days or few weeks, depending on how things play out. But in long terms, most of the businesses in India, I think, will continue to thrive and build great franchises. Valuations have come down massively in many of them over the last 18 odd months, and are offering, I think, great entry points. So from that perspective, be it consumer sector, be it manufacturing on pharma, chemicals, probably even engineering goods is something. War brings it with it a lot of destruction, and it will get, I think, a lot of infrastructurefication again in a few months from now. So whatever people are dabbling with in terms of things which are looking quite bad today, I think will turn to be gold mine in a few months from now, because whatever is not working right now will work and fly really well in I would say towards the end of the year.
Yeah, so equity, definitely, I guess this is the time when you have to show the conviction and show the patience to really get big rewards in your portfolios over the medium to long term. So Shant, I mean, are people also diversifying away? That's something that we've anyway seen for the past couple of months, because Indian equities have been underperforming for a long time. So are you also seeing people talk more about, say, investing in gold, now that gold is at least correcting, other asset classes? So my question is that has there been a lot more competition now building up for Indian equities?
Yeah, no, definitely. As if the markets don't deliver for extended period of time, people start doubting the return profile of the asset class, and that's where I think people have been looking at commodities. People have been looking at international equities as well. While Indian equities have not done well in 2025 and first a few months of 2026, global equities have done well, and there has been a lot of client interest on doing some allocation on global equities alongside commodities. I think commodities probably the FOMO was more towards the end of 25, early 26, but now I think people are still talking more about international equities than commodities. Having said that, our view is that diversification is a good tool to have your portfolio being sanguine at all points of time. But at the same time, the complications which international equities bring alongside taxation, accounting, etc., is something which people should not overlook. I would say it's an important part because it's very easy to send money, it's very easy to invest, but how easy it is to bring it back, and how easy it is to file your tax returns and do an accounting treatment and disclosures, etc. I think things get complicated. So it's not, I would say, meant for anybody and everybody. People who have, I would say, good setups to play through all these complications are the ones I think should be doing more of that rather than anyone and everyone.
Okay. All right, Sushant, thank you very much for joining in and giving us some perspective on this market, which is continuing to struggle with the bigger macro issues at hand. But I think this is where we have to just keep the faith and keep our head down, select good stocks, and then wait for things to turn around. Thanks for joining in. You have a good session. Good day.
Thank you.
you. Okay, so, let's do one thing. The market's volatile. It's also now positive. Let's not lose sight of that. After falling dramatically, now there's a recovery. There's a 70-point recovery on the Nifty. The mid-cap index has also turned positive. So this is the extent of volatility that we're seeing right now. Like Sushant is saying, like most guests have been saying, that this is also a great time to get in and buy. The question is, how much do you buy? How much do you stagger? And that is what's leading to the volatility. But this is very heartening to note. After a long time, we're seeing dips getting bought. Let's see. Early in the morning, it's only about 9:35, and it's been a volatile start for sure. Before we bring you our next soundbite or the next snippet from the Global Wealth Summit, I want to talk about some of the interesting brokerages for the day. Recommendations for the day. Citi came out with a call on Indigo. They came out with a buy call. The target price is 5,100, by the way, on Interglobe Aviation. And Citi's argument is that, the fuel surcharge is going to be offsetting higher jet fuel prices. Sector-wide surcharge could lift yields by around 8 to 10%. And that's what's making them positive. And anyway, the stock has fallen a lot. So they say that this is potentially a good entry point. L&T, there is CLSA, which has, given an outperform call on L&T. Their target price is 4,842, and they feel that the current correction offers a great buying opportunity. They're saying Saudi Aramco, which is one of the big clients for L&T, is guiding for flat 2026 capex. So need to sort of watch for all of this, but the current valuations are now providing good visibility and probably a good entry point as well. Let's look at OMCs. HSBC came out with a call on oil marketing companies, downgrading OMCs to a hold. They've cut earnings estimates, they've cut multiples as well, saying that higher crude prices could lead to marketing losses, even if oil is at $75 a barrel. Anyway, no one's talking 75. You just heard a rupee expert say that the new normal seems to be around 90. But they're saying even at 75, there'll be marketing losses. This is going to be very, very difficult. That's a call on IOC, BPCL and HPCL by HSBC. And finally, looking at autos, Incred came out with a call on autos. They're overweight on the sector. Incred's top auto picks are Maruti, Ashok Leyland, Eicher. These are some of the stocks that they like, saying that sector valuations are at about 10-year averages. And the supply chain for OEMs has not reported any major production issues as yet. Contingency plans are in place. So they feel that, overall autos do present a decent opportunity. And therefore, they've given out some of those names, including Ashok Leyland, Eicher and Maruti. So some brokerages. Okay, now let's give you that snapshot from the Global Wealth Summit. We caught up with Saurabh Mukherjee, founder and CIO at Marcellus Investment Managers. And Saurabh explained why he has split his portfolio 50-50 between India and global markets. So 50% of Saurabh's money is now getting invested in overseas equities. Let's listen in.
4 years ago, I decided I'll have half my money here and half my money bahar. My thinking was very simple. My bachchas wanted to study outside. Plus, I realized my phone is made in Bangalore. It's an iPhone made in Bangalore. But I looked at the phone and I realized 90% of it is imported. I looked at the electronic equipment that our hosts shared with me whenever I speak on media, and I realized that's imported. I looked at the flights that I was taking in India, and I realized the planes were imported. The fuel inside the planes was imported. I realized even the in-flight magazines in our country were imported. I also realized that the movies I was watching on OTT was on an imported OTG channel. And I saw my kids were listening to songs on Spotify. And the most common source of entertainment in India had become YouTube. So I said, I'll have half my money here. I'm dramatically overweight India. I think India is 3% of global market cap. So half my wealth, 50% is here. So I'm big time overweight India. But I said, I'll put half my money in Europe and America, even though they account for 75%. So in that regard, I'm underweight. I'm underweight the Western Hemisphere. And I feel fairly comfortable about that. Half here, half there. So as my wife, every year my wife asks me how much money have we made. So the way I put it is, kabhi yahan pe pitai, wahan pe kamai, kabhi wahan pe pitai, yahan pe kamai. Barring COVID and Lehman Brothers, we haven't seen both ends of the world getting plastered at the same time. So usually we get hammered and they're all right, or they get hammered and we are all right. And the good news is over 10, 20 and 30 years, and it's actually not just good news, I think it's remarkable news. Over 10, 20 and 30 years, Surabhi, the only two big markets which give you double-digit dollar returns are United States and India.
All right, some snapshots from the Global Wealth Summit. It was a full day-long mela of everything investing, from macros to micros to equities to fixed income to commodities to gold, silver, and so on and so forth. So you must go on our YouTube channel, because a lot of these panel discussions, all of them, all that content is on our YouTube feeds. So make sure you go and check out a lot of the guests that you like listening to. You'll probably find them there. Okay, for the time being, let's actually get down to that macro conversation and the big macro question. Oil at $100 a barrel. It doesn't seem to be going back in a hurry. So what is the implication now for India's macroeconomic stability? Well, we have Dr. Shubda Rao joining in, founder of Quant Eco. Shubda, good morning. Thank you so much for being with us on Money Control. Great to connect with you on the digital medium. At least Shubda is wearing green. How beautiful. At least somewhere, kahin to thoda green hai. I think, Shubda, you're on mute. Shubda, you're on mute.
I am terribly sorry. Firstly, I think Surabhi, it's fabulous to connect with you again after quite some time. And yes, I'm wearing green predominantly, but mind you, with the edges of red. So we need to be cognizant of the risks on the horizon for sure. Yes, I think we are staring at prolonged kind of, geopolitical tensions in West Asia and, coming in from Iran and US and Israel. Quite clearly, if the bottom line of the message is that if this conflict continues with same intensity into next few weeks or a few months, India would be staring at a risk of destabilizing some of the hitherto macroeconomic variables, having been enjoying a Goldilocks kind of a scenario so far. We have a rise of 28% in our energy prices. Obviously, that is going to have repercussions. Currently we are at an Indian crude basket averaging at 70. Even if we see at 100 until the end of this month, which is the fiscal year end, we would be around $70, $71 to a barrel. And if we are looking at oil at 90 or oil at 100, all the macroeconomic variables are going to become vulnerable to the 28% increase in the energy prices. At Quantico, we did do a scenario analysis. At this juncture, this is probably the best we can do, because all of us are unsure of the duration of this conflict. While we are aware of the current intensity, but how long the similar intensity will continue is a question to be asked of everyone. Therefore, a scenario analysis presents a best kind of way of looking forward to what kind of risks we should be prepared for. I think starting with growth and inflation, because that's where the Goldilocks scenario has prevailed in India for the longest period. If we look at oil at 90, from the growth of 7.6 as put out by the MOSPI, though we ourselves feel that March is going to hurt in terms of growth, and therefore somewhere closer to 7.4 would be a realistic estimate, once we get a final number. But having said, from 7.4 to 7.6, we would be looking at growth cut of almost 100 basis points to 6.4, 6.6 if oil prevails at 90 through the fiscal 27. Inflation, which was hovering around 2.1, will more than double to 4.6%. Obviously, fuel impact would be there, but more importantly, the indirect impact, the spillover impact, second order impact, whatever we call it, would be larger, in my opinion, across the economy, and that would impinge on the CPI. First, the WPI, but more importantly, the CPI. As we have seen very evidently, Surabhi, that, the second order impact was quicker than the first order in this last phase of 2 weeks, the way we saw the transportation costs, the logistics, the supply chain disrupting. So that is point to be looked at. I think obviously no-brainer here that external account is going to be the most vulnerable. We've enjoyed a current account gap of 1.1. Yeah. Sorry, Surabhi, you were saying something.
Yeah, so Shubhda, I just, we have a very neat table that Quantico Research has put out, and it very neatly sums up all the scenarios before the war. I mean, the FY27 projections, Shubhda's projections, GDP was supposed to be between 6.6 to 6.8%. Then the scenarios, oil at 80, then post-war oil at 90 and oil at 100. Now, let's look at the worst case. GDP could move from an estimate of 6.6, maybe it ends up being just between 6 to 6.2. CPI inflation is looking really, really difficult. 4% was the earlier projection. Worst case, it could go to 5.1%. And the current account deficit, which has been, that's exactly the point that Shubhda was making, that it's been very, very benign, I mean, relatively benign at around 1%. It could double to 2.2%. But Shubhda, I wanted to understand that for these scenarios, oil at 90, oil at 100, are you assuming that this will be the average price of oil through the year? Then we get to those scenarios. So the worst case will materialize if oil stays at 100 through the year.
That's right. This is the average crude price for the year. And those are the, as you rightly put it, this is the worst case scenario that we have presented. Because at this juncture, none of us are can attach any probability in terms of the duration of this war. I mean, let's face it, Russia-Ukraine was supposed to last a few weeks, and it's into fourth year or maybe fifth year. We are not likely to see, the West Asia and the Middle East crisis of that longevity, purely because the global economy is extremely vulnerable to energy prices and inflation, and therefore it would just unleash destabilizing factors to the global economy, which won't be doing good to any economy, because the Middle East is going through a serious pressure of the destruction of infrastructure, of energy. The rest of the world is seeing a serious disruption in the global supply chain of energy, particularly through Hormuz. And if you had our note, you would have seen that we'd also put out our exposure to the consumption, our domestic consumption relying on imports. For crude, it's 85%. For LPG, it is about 55, and for LNG, it is about 50. But if we look at just Hormuz, which is a key blockage at this point in time, half of our crude depends on Hormuz, 60% of LPG, and most importantly, as we are experiencing the gas supply crisis, 70% of it gets routed through Hormuz. So clearly we have to watch out for how long the Hormuz strain will continue. Yes, our diplomatic channel has been doing very significantly positive moves, but at the end of the day, supply is going to be crunching, and the rest of the world is also going to be looking at diplomatic channels to work on Hormuz as an important entry point for their global energy imports. Having said, I think every day is a new day in terms of equations between US, Israel, and and Iran, and its impact on, more importantly, the rest of the Middle East nations, which are also, facing the destruction of the energy infrastructure. And that is where the globe remains vulnerable. We have already seen, IMF also sounding out that within the short span, it's likely to see a cutback of at least 0.3% in global GDP, as well as on inflation to the extent of about 40-50 bips. Now, that is something that the world would be less prepared for if the intensity of this war goes into many months, as we currently have limited idea about, should I say, we are clueless about when the war would end. There should be an effort, hopefully, from both sides to come to the discussion table and resolve it. But I think, the government will have to be nimble in terms of adjusting a whole lot of its budget math through the year, because we will need to see some kind of tax tweaking so that the consumption doesn't get the heat all of it through the year. We will see some bit of it on subsidies getting adjusted. We're already staring at, the potential supply disruption in fertilizer imports. Agriculture itself remains vulnerable to the climate. We have seen initial pronouncements about, El Nino risk coming on to our monsoon season, which would also perhaps have some risk of food inflation coming on board, which incidentally was the most benign in the last fiscal year, or the ongoing fiscal year. So we will have to look at food, we'll have to look at fuel, and more importantly, the second order impact of fuel on the economy and on the consumer price inflation. So the scenarios do not obviously look less trivial, if we call it, but I think a lot of mitigants can be put in place. The green on me suggests that, let's face it, what if this crisis was a decade ago? A decade ago, remember, our growth had halved, our inflation had doubled close to 9% or thereabouts, right? Around the 2013-14 energy crisis, where 3 consecutive years we had seen average crude prices over 100. And that's the time we had seen direct repercussions on our macroeconomy. Are we in a similar situation? I would definitely not think so. We have fortified our economy with reforms, with, inflation framework having come in place from 2016 onwards. I think all these institutional reforms and the domestic economic reforms have brought in some kind of ability to be able to withstand some of these risks for the longer period of time.
Got it. So, this is a complex scenario, Shubhda. And there are a lot of moving parts and nothing is certain as of now. Final point on the currency, I noticed in the worst case scenario there, the projections do talk about the rupee maybe weakening to as much as 96, 97. We're at about 92.50, just below that now.
Yes.
How does, that kind of complicates everything all the more, right?
I would think so, because when I was talking of second order impact, of this, because it's going to directly impinge on our external account. And it's not just the trade deficit, and therefore the current account gap would widen to about 2.2%. But more importantly, Surabhi, as we've been seeing, the investment flows, which are a good buffer to take care of your, current account gap, those have been on the receding side for the a few quarters now, and that would make our currency even more vulnerable. So earlier it was just the the market channel through which rupee was looking a bit under pressure, but here you would add a little bit of macroeconomic fundamentals also adding on to the currency pressure. In fact, if oil is at 100, our own forecast is rupee could test the levels of 98 to 99 also to $1, and that purely emanates because if you look at remittances, 38% of remittances come in from Gulf nations, which have been an extremely strong buffer in limiting our current account gap. So we will have 38% of that remittances looking exposed to risk. Also, our trade, 11% of our exports are to the Gulf nations, and those would also come under risk if this war prolongs. So it's not just the basic macro arithmetic that we look at, but the indicators that feed into these macros, we need to look at them more closely in terms of remittances, in terms of exports, which are exposed to directly to Middle East. But the second order and the knock-on impact on the rest of the world, and therefore the global economy, the global demand conditions, all of these would be, tested quite sharply and severely. But having said, I said it's always a case of relativity, Surabhi. How does India, withstand this kind of intense risk compared to all our competing nations, in terms of peer economies or even in terms of some PMs? How do they fare? I think it's going to be, is going to be the game that will be watched very closely over the next few weeks, hopefully not next few months. Sure. But on a realistic note, I think we are definitely going to we are going to see a spillover with the start of the next fiscal year, which is just a few weeks away. So I think a government will have to, the ministry has already created a stabilization fund. I think we need to understand how it's going to work. Supplementary grant, demand for grants has been put in place. Absolutely. But the mechanics need to be closely watched out for what exactly is going to be, addressed through that stabilization fund of about 1 lakh crore. And it's basically adjusting your economic response to the disruptions to our macros. As simple.
Yeah. And I think in all the scenarios that you brought out, I think the view right now seems to be that a quick climb back down to the 70s level may be sort of wishful thinking at this point in time. Our previous guest was also making the same point that 90 seems to be some sort of a new normal or a new base, at least in the foreseeable future, till there is full conviction that the war has ended, full conviction that the region has gone back to, pre-war normalcy. I think we're in a different era right now.
Yes, the last
point. Yeah, you were saying.
Yeah, no, very quickly, actually, in our note, we had put out that India can withstand oil at 80, with minimal damage to our macros. 80 is okay, but as soon as it climbs another $10, I think that is going to be testing some of our macros. Though I think, as I put it, it's going to be how government responds on various stress points of these macros, be it on inflation, be it on external account, or be it on, more importantly, the fiscal, the arithmetic. How are they going to be able to withstand all of it? I think that is going to be seen over the next few months. The Q1 of fiscal 27 is going to be put to severe test on all these macros, and that's what we look out for as to how we are going to redraw. Let's not forget, Surabhi, the closing point that I would like to make is after tariffs, the global economy redrew its trade regimes and trade arrangements. Would energy also do that in terms of how do we, bolster our domestic, supplies, our domestic infrastructure to be able to minimize our vulnerabilities? Absolutely. So each of the country is going to look inward to see how they can fortify themselves to these very immense, intense global risks.
Yeah. Absolutely. I mean, markets react to the here and now, but we all know, if we go back in history, that geopolitical changes have deeper ramifications. They run deep and they continue to impact trade, flows, sentiment, supply chains, for many months, sometimes even years ahead. And I think this is that sort of juncture that we're in right now when it comes to world history. Shubha, thank you so much for joining us this morning. Great conversation. You have a fantastic day.
Pleasure.
And we look forward to more of your inputs through the coming weeks as well. Thank you.
Thank you, Surabhi. Wishing you a happy week, hopefully.
Thank you. Thank you so much, Shubha. You have a good one too. Okay, quickly before we wind up today's show, the market is at least right now, 10 o'clock on Monday morning. The bulls are prevailing. People have come in, they've tried to buy the dip, and the bulls have managed to put some green on the screen. 0.25% higher on the Nifty. Mid-cap index is up about 80 odd points. The bank Nifty is up about 0.4%. It's a pretty wide spectrum of stocks where the gains are coming in from. Grasim, Ultratech Cement, Hindalco, Interglobe Aviation, JSW Steel, Tata Steel, ITC, State Bank of India, HDFC Bank, Nestle, Eicher. It gives you the sense that this is a very broad-based kind of an overall recovery that's playing out, at least for the time being. Let's see what the next couple of hours of trade bring. But for the time being, from the entire team that puts this show together, it's a wrap. Thank you for watching. But we do want to leave you with snapshots of Moneycontrol's Global Wealth Summit that took place over the weekend. Here are some of the top voices from the world of investing and markets sharing their outlook on the way ahead in the new normal, where geopolitics has become front and center for markets. Take a look, and thank you for watching.
Today, for a lot of new age companies which are not making profits or elevated valuations, 40, 50 times, where companies are growing fast, we see that there is a secular growth story. People say that high valuations are fine because they are going to, grow structurally for a long time. But a simple math, a PE of 40 times. 10 years it has to grow 20% year after year after year. If after 10 years it is supposed to converge at a PE of 20, you have to grow at 20% year after year. Do we really have those kind of structural stories, Sanjay? Can you really defend?
That's called a half volley on leg stump. You short these companies. But that's a predominant part of our market. I mean, it's insane. Just because a guy wearing a Ferragamo tie and a fancy suit sells you some crappy story, and it's called New Age.
No, it's not just New Age. I mean, that's just one thing I pointed out. But a whole bunch of companies, EMS companies, a lot of manufacturing companies.
So, Mahalakshmi, the issue is here. It varies from company to company. It varies from company to company. I don't think it's possible to generalize. I think, and the why we have this difference between whether buy and hold is dead and it's not. Buy and hold works really well for guys who are exceptionally talented investors. So if you buy really high quality businesses and you have a knack for doing it, as he has done again and again, I've known him for 42 years now. He has that ability. But how many other people have that ability? I mean, I don't have it. That's why I don't do it.
So do you buy and hold?
What
is your holding period?
Whenever I buy something in common with him, I hold it.
Okay.
I bought Hero Honda.
So all Ramdev stocks we should hold for a long time.
100 baggers he has got. He's the guy with highest number of 100 baggers.
So what is your average holding period, Sanjay?
I'd say it's about 3 years.
3 years.
Though I've held Hero
By
Honda
the way,
with
for the benefit of this audience, although we know that, Buffett saying that you should hold for his favorite holding period is forever, it is nothing but true, because the study has shown that his holding period of an average stock is only 2.5 years. Let me repeat that, only 2.5 years.
That's 2.5 is like very low. I typically buy for 20-25 years. So, see, buy and hold is one thing, but buy and hold forever is yet another. I'm not in that camp, a buy and hold forever. No company lives forever, So, but see, companies are also like human beings. They have a productive period, there is a growth, then finally that concept itself goes off, like Kodak moment comes for every company. So you have to, but then you have to live through the prosperity of a company. If a company has to go from 100 million to 100 billion, if you don't hold it, how will you make money? I mean, your same Infosys or HDFC or, unless you hold them, you cannot really reap that. You have the purchase price advantage in a compounded growth scenario. If you have bought it right at the beginning, actually, when the markets like this, they correct, you just don't feel it because you bought it so cheap.
I just want to deal with two issues, AI and its interlinkages with the macro questions that are coming up. I'm not going to the war and oil prices. That will resolve as and when it does. I mean, none of us have the answers. But Ajit and Shankar, maybe on AI, because that also was raised as a structural challenge for India. What if it triggers job losses, then the Indian consuming class and the great Indian middle class? Will it have several layers of a sort of a spillover effect?
I think on the AI side, it's all unknown. I think it's everyone who we speak to, again, we're not engineers, we're not scientists, people we speak to recognize, and every company we talk to, most of them will tell you what they can do to improve their productivity and how they may be able to use AI agents to get their sales moving. But they can't quite contemplate how it's going to impact them in terms of employment, profitability, society, etc. I think we're very early in that cycle. If AI was to take the doomsday scenario that is going to knock off employment, we're in trouble. We already were in trouble from 2005. We were supposed to create about 10 million jobs a year. We haven't done that. We're nowhere close to that. So if AI comes in and does it, we'll have a massive social disruption in India.
Shankar, are you investing more in the market now, Monday ko?
I think oil prices are a new googly in already a lot of googlies that existed in the last 2 years. And I think my view is that it's a structural bull market in oil. It's not cyclical because oil has been cheap too long. Just as gold was cheap too long, we saw how gold did. Now oil is going to be the new gold. And I think you could be looking at, I don't know, $150, $200.
Sachi, final thoughts.
Look, I'm a long-term investor. I also believe that my job as an investor is not to predict the future, but it's just to manage the risk. Where will oil go in 2 months? Where will market go in 2 years? I have no idea. All that I know is, if I have to pick a geography, a economy to invest for the long term, it is definitely India, because there is no other large economy that is going to double, and it's going to double again in the next 15 years. I will rest.
Shashank, you have managed to very successfully tap into this whole wave we are seeing in terms of awareness of protein, clean label, healthy label. And you come from a background in FMCG. How has it been for you to unlearn the traditional way a huge FMCG operates with a lot of distributors, trade channels, to building a protein brand from scratch?
Actually, I'll start with the correction. We'll always be a 100% clean label food brand.
Okay.
We just happen to be selling protein shakes right now, protein powders right now, but we make muesli, peanut butter, chocolates. In the future, we'll make cookies, sauces, anything in your pantry where you feel your current brands have been lying to you and your trust is broken. We'll try and come in and rebuild that trust by giving you 100% honest food. And hence, to answer your question, I think protein is a wave. It'll come and go.
But clean label is the overarching theme.
And even behind that is the need for honesty and truth from your brand, which I think is a 100-year, 200-year, 500-year fundamental human insight, which will not change, because once no one likes being lied to. And we've been lied to by our food brands for decades now. That's fundamentally what we are trying to fix. The food we make is just the medium through which that promise manifests. Yeah. And on your question of large companies se kya sikha, like honestly, I think we are still in that 100-year-old business, right? Like we are making food somewhere and we are selling it to someone. Only some channels of reaching that consumer mentally and reaching that consumer physically are changing. So only the conduits are changing. Fundamentally, the business is the same. We are the manufacturer, we are the marketeer. There is some middleman through whom we reach our consumer and give them the product, right? And the fundamentals of FMCG don't change. You increase mental reach and you increase physical reach. If these two things increase at a similar rate, your brand will grow.
Madan, you and I have spoken about this, average conceals the valuation discrepancies that you see in the underlying. And the last time we spoke, you said 10 to 15% of the stocks are essentially below the, long-term averages in terms of valuations. Has that equation really changed? And therefore, for the overall broad markets, how much more downside do you see?
It's tough to put a number, but to a specific question, what percentage of markets are at, say, investable zone from valuation perspective? Over the last 1.5 years, most of the conversation among fund managers, investors, and when we meet the investors, center around macros, geopolitical events. Many of them were not so relevant in the context of making a longer term investment. Valuation divergences in market, which always exists, in every market you will find that, but the degree of divergence, especially over the last 3-4 years, has been sharply higher. That led to more than half the companies in major benchmarks being super expensive levels. And that's getting corrected, but it hasn't got corrected to a level where you can say majority of the stocks are in the investable range. But to put a specific number to your question, what otherwise would have been 15-20% of the market that were investable maybe a few months back would have become 5-10% more. But still, you may find almost half the markets you can't justify based on current valuations.
Ghulam, I think a large number of investors in Dubai's real estate markets were Indians. So whatever is happening there, first of all, your thoughts on whether it's going to be temporary or whether it really shakes up the market and there's a bit of at least a medium-term issue that crops up in pricing, in interest. How does that play back into Indian real estate? Be it on commercial, be it on, I'm talking purely from an investment perspective.
Well, first of all, please excuse me if I'm not using that D word. There is a ban. We can't talk about that city that you want me to talk about. Yes, the concerns are there. Why from Middle East people are looking at some better investment opportunities, that lifestyle, etc. That question of a peaceful life is challenged. So there are alternative investments discussed, and openly quite a few may be actually taking that call of relocating or looking at other assets. But what is the impact on Indian real estate? If there is a question,
will that money look at in real estate investment opportunities now in India is my question.
See, first of all, you actually saw a flight because they wanted to go away from India, so they'll ended up in one place or the other. So if you are forcing them to get back, that's a big question. Will they? I would rather say they will look at elsewhere, or they will talk about some other better markets to invest. And this money, look, repatriation, if that is a question, I'm sure there are experts sitting over here who can tell you that if you have taken some money out and then RBI was chasing you, getting that money back is going to be even bigger of a problem. So the question is, you had some money here in India, you are buying something here is one thing. But if you are an NRI, if you are living in other countries, be it Middle East or anywhere else, I don't think it ever made sense. I do see a lot of these developers claiming that हमारे पास NRI buyers आते हैं, but buyers know here this currency is going down at 3.5 to 4% every year, if not 5. So there is no sense of bringing in money from abroad and buying real estate in India, where you know that even if the property prices are going up 7-8%, the money itself is coming down 3-4%. And that also, the 4-5% or 7-8%, or even, I'm sure last 3 years, we always talk about the rosy side of it. So last 3 years, the prices have shot up good, very well. But prior to that, almost 9-10 years, there was no appreciation. So if you look at a net long-term growth of real estate, even residential, it will not be more than 7-8% per year.
So you don't see the money coming, running back to India in a hurry?
I doubt.